What's up, everybody? David Yang here again with Home Sellers. I want to thank you all for tuning in to another episode of Real Talk, where I talk about real estate. In this week's episode, we're going to be talking about cash-out refinances versus HELOCs, or home equity line of credits. Now, if you could do me a big favor before we start the video by smashing that thumbs up button below and subscribing if you haven't done so already, it really helps out the channel and it opens up to newer audiences that might need this information as well. Alright, so one question I've been getting a lot of is, David, is it a good time right now to cash out refinance, or is it better to do a home equity line of credit or HELOC since interest rates are going up? So let's talk about cash out refinances first. What is a cash out refinance? So if you are going to cash out refinance your home, what you're going to do is you're getting a new loan to pay off your old loan, and whatever excess is, that's what you get to keep in your pocket. That's what the cash out portion is. So say, for example, if you have a house and you have a loan for $100,000, that's your balance that you owe for it right now, and you take out a new loan for $150,000, you would use $100,000 of that new loan to pay off the old one, and then the extra $50,000 you would put that in your pocket as the cash out portion. So that is a cash out refinance. Okay, now one thing that you have to understand is you probably most likely got your old loan when interest rates are down a little bit. Okay, right now interest rates are roughly around 5.5%. Depending on your credit score. So the new loan will come with current interest rates as they are. Now there is ways to buy down your rate as well, but let's just say that you're going to go with whatever the market rate is. I'm willing to bet that as of today, your loan that you're going to get for your cash out refinance might be more expensive than the loan that you had previously. Okay, so that's one thing that you have to think about when you're doing a cash out refinance is, yes, you'll get a big lump sum of cash, but you might have a higher monthly payment due to the higher interest rates. So you have to determine if that's going to be a good option for you. Now let's see how that compares to a home equity line of credit or HELOC. So basically what a HELOC is think of it sort of as a credit card that is attached to your home. Okay, so the difference of a HELOC is you're not refinancing your old loan out. Okay, so your old loan is going to stay in place. What you're going to do is you're going to go get the line of credit or the home equity line of credit as usually a second mortgage to the home. Okay, so your first mortgage is going to stay in place, and you're going to add a second mortgage, which is the HELOC. Okay, so the HELOC, what that is again, let's think about credit card. You don't have to pay it back until you use it. So let's just say that you had your mortgage from earlier of $100,000, but you want an extra $50,000 just in case you need to do whatever it is you want to do with it. Okay, so you go to the bank and you say, hey, I want a HELOC for $50,000. Okay, so they're going to look at it and they're going to make sure that you have enough value in your property, and they say, okay, sure, we'll give you a HELOC of $50,000. Okay, now that $50,000, it's going to be whatever rate that they want to give you. Again, you know, with the current interest rates, just that HELOC is going to be subject to those rates. Okay, and then whatever terms that they have, whether it's variable term, fixed term, whether it's 5 years, 10 years, however long that term is for that HELOC, that's what that is going to be. And again, all while this is happening, your original mortgage is going to stay in place. Okay, now the thing with that HELOC is, again, you actually don't start paying it back until you actually use it, kind of like a credit card. Okay, so you can have that HELOC and have your original mortgage. You'll keep making the payments on your original mortgage, but you won't make any payments on the HELOC until you actually use it. So let's just say this year you open the HELOC, but you never use it. All you're paying for is your original mortgage at your original interest rate, so that will not change. But let's just say 2 years down the road, you have a medical emergency and you say you need to use $10,000 of that $50,000 HELOC. Okay, at that time that you take it out, that's when you'll start making the payments back on the HELOC. Okay, At the same time, you're still going to be making payments on your old mortgage. So just keep that in mind. You'll have 2 payments at that time, okay, if you go the HELOC route. Now, which is better, the HELOC or the cash-out refinance? That really depends on your situation. So you want to talk to your mortgage professional to see which one is going to be a better option for you. Again, the main thing is cash-out refinance. You're going to be paying today's rate when you cash out, and you're going to be repaying it right away, okay, because you get the cash right away. The HELOC, you're going to be paying today's rate if you use it today, okay. But you don't have to pay it back until you actually start using it. So those are the 2 differences, okay. What I see is I think a lot of people are going to start moving into HELOCs, especially they have a lot of equity locked up in their property and they can't really access that equity. So HELOC might be a good option for you if you're trying to do that without having to pay the interest rate for the entire mortgage. So might be a good thing for you to check out if you need to tap into your equity, because really the only other option is to sell your home if you want to get that equity. But then that goes into what I call an equity trap, because now you have to sell your home and you have to live somewhere else, but interest rates are higher, okay? But you're going to get a cash out refinance, but interest rates are higher. So what do? A lot of people might look into the HELOC, kind of like what I said. Okay, thanks for watching the video, guys. So as a quick question to you guys, inflation numbers just came out this past Wednesday. So we're sitting at about 9.1% for the CPI, or the Consumer Price Index. The Federal Reserve is set to meet in the next few days here and possibly increase interest rates, the federal funds rate, okay? So how do you think that is going to impact mortgage rates? Let me know in the comment section below. Again, this is just a really quick rundown of cash out refinances versus HELOCs. If you have any questions about them, let me know. If not, I will see you guys next week on the next episode of Real Talk.